Hey everyone, and welcome back to Dollar Glitch, where we decode the market mysteries for you. Have you ever looked at a stock, seen its price, and thought, that can't be right? It's too cheap. Well, what if I told you that sometimes those gut feelings are spot on, and you might be staring at a once-in-a-lifetime opportunity? In a world where everyone's chasing the next big thing, missing out on an undervalued gem is like leaving cash on the table. Today, we're not just talking about cheap stocks. We're talking about dangerously cheap stocks that are practically screaming, buy me. We're diving deep into the 5 undeniable signs that a stock is so undervalued, so overlooked, so downright cheap, that ignoring it would be a financial blunder of epic proportions. Get ready, because by the end of this video, you'll have the insider knowledge to spot these hidden treasures before the rest of the market catches on. Imagine turning a small investment into a significant gain, all because you knew what to look for when others were blinded by the noise. Sound too good to be true? Stick with me, because the truth is, these opportunities are out there, and I'm about to hand you the flashlight. Let's kick things off with our very first sign, and trust me, this one is often right under your nose. Before that, don't forget to click on the subscribe button. Sign number 1 that a stock is too cheap to ignore. Its price-to-earnings ratio is significantly lower than its industry average and historical norms. Now, I know what some of you are thinking. P/E ratio? Boring. But hold on, because this isn't just about a number. It's about a story. Imagine 2 identical houses in the same neighborhood. One is listed for $500,000 and the other for $250,000. Which one would you investigate first? The cheaper one, right? The P/E ratio is similar. It tells you how much investors are willing to pay for each dollar of a company's earnings. If a company is consistently making money, growing its earnings, but its P/E ratio is lagging behind its peers or its own history, that's a massive red flag. Or in our case, a massive green light for opportunity. Think about a fantastic... Moving on to sign number 2. The company has a strong balance sheet with substantial cash flow and low debt, but its stock price doesn't reflect this underlying strength. Let's be honest, in today's unpredictable economic climate, cash is king, and low debt is the ultimate shield. Picture a company as a fortress. If it has piles of gold, cash, inside, and no gaping holes in its walls, debt, it's incredibly resilient. So why would the market be treating it like a crumbling shack? Sometimes companies that are financially rock solid just aren't sexy. They might be in a stable, perhaps even boring industry. They might not be making headlines with groundbreaking new products or disruptive technologies. The market, often driven by hype and short-term trends, might simply be ignoring these steady performers. But for smart investors, a company swimming in cash, generating consistent positive cash flow, and carrying manageable debt levels is a powerhouse. It has the flexibility to weather storms, invest in future growth, or even return capital to shareholders through dividends or buybacks. If you find a company with these financial characteristics but a stock price that's stuck in the mud, you've likely stumbled upon an overlooked powerhouse waiting for its moment to shine. Don't get swayed by the flashy headlines. Sometimes the quiet giants are the best investments. Before we reveal sign number 3, if you're finding these insights valuable and want to stay ahead in the market, do me a huge favor. Smash that like button, subscribe to Dollar Glitch, and hit the notification bell so you never miss another money-making opportunity. Your support helps us bring more awesome content like this directly to you. Seriously, it makes a huge difference. All right, let's dive into sign number 3. Significant insider buying by executives and directors. Who knows a company better than the people running it? Nobody, right? When the CEO, CFO, or board members start buying large chunks of their company's stock with their own money, it's a profound signal. It's not just a vote of confidence, it's a financial commitment. They're not just saying the company is undervalued. They're putting their personal wealth on the line because they believe it's going to go up. This isn't your cousin's hot stock tip from a Reddit forum. This is insider action that screams conviction. Now, be careful. A few small buys might not mean much, but a consistent pattern of significant purchases across multiple insiders is incredibly telling. They have access to information that you and I don't, and when they're willing to bet their own money, it suggests they know something good is coming. It could be an upcoming product launch, a new contract, or simply the belief that the market has fundamentally mispriced their company. Always check insider activity. It's one of the clearest indicators that those who know the most believe the stock is an absolute steal at its current price. Don't underestimate the power of insider conviction. And now for sign number 4. The company is experiencing temporary, but fixable, problems that are overshadowing its long-term potential. Let's face it, every company, even the greatest ones, hits bumps in the road. Think of Apple after Steve Jobs was initially ousted, or Netflix when Blockbuster seemed insurmountable. These were moments of crisis, but they were also moments of profound opportunity for those who saw beyond the immediate pain. The market often has a very short-term memory. A bad quarter, a product recall, a lawsuit, or a change in management can send a stock plummeting, even if the core business remains incredibly strong. Your job as a savvy investor is to differentiate between terminal decline and temporary turbulence. Is the problem structural and permanent, or is it a solvable issue that will pass? If a fundamentally sound company with a competitive advantage and a solid market position is trading cheaply due to a temporary hiccup, you've found a classic value play. These are the moments when fortunes are made. Buying when others are panicking, when the news cycle is negative, but the underlying business remains resilient and poised for a comeback. It requires patience, a bit of courage, and the ability to look past the headlines, but the rewards can be substantial. Finally, we've arrived at sign number 5. And this one is arguably the most powerful. The company is trading below its intrinsic value, often indicated by a low price-to-book P/B ratio or a robust discounted cash flow DCF valuation. This is where value investing truly shines. Imagine you could buy a brand new, fully equipped car for half its actual value. You'd jump on that, right? The P/B ratio essentially compares a company's stock price to its book value, what it would theoretically be worth if it liquidated all its assets. A P/B ratio below 1 can sometimes indicate deep value, but it's not always a guarantee. More sophisticated investors use a discounted cash flow DCF model to estimate a company's intrinsic value by projecting its future cash flows and discounting them back to today. If your DCF model shows a company is worth significantly more than its current market capitalization, you've hit the jackpot. This takes a bit more effort, some financial modeling, and understanding how to project future earnings. But it's the gold standard for identifying truly undervalued companies. When the market is fundamentally mispricing a company's true worth, you have an opportunity to buy a dollar for 50 cents. It's about seeing the true potential, the underlying assets, and the future earnings power that the market is currently ignoring. Mastering this sign can transform your investing journey. So there you have it. The 5 undeniable signs a stock is too cheap to ignore. From a low PE relative to its industry, to a fortress-like balance sheet, strong insider buying, fixable temporary problems, and trading below its intrinsic value. These indicators are your roadmap to uncovering hidden gems. Remember, investing isn't just about chasing the next hot trend. It's about finding value where others don't, being patient, and having the conviction to act when the data aligns. If you learned something new today, hit that like button, share this video with a friend who needs to see it, and let me know in the comments below which sign you find most compelling. Have you ever spotted a stock using these signs and made a fantastic return? Share your stories. Your insights